All right, everybody, listen up. For the longest time, if you had a brilliant idea for a business, what did you do? You put on your best suit. You walked into a bank. You begged for a loan. You had to convince some powerful person behind a big desk that your dream was worth their money. More often than not, they would look at your paperwork, shake their head, and send you on your way. You were denied. The same was true if you wanted to invest. You needed a lot of money to even get in the door with a fancy broker, and the best opportunities were saved for the super wealthy. It was a closed club, and most of us were not invited. That was the old way. But then, something incredible happened. The internet, the digital world connected all of us in ways we never thought possible. It didn't just change how we shop or talk to our friends, it completely turned the world of money on its head. Suddenly, you didn't need to go through the traditional gatekeepers anymore. The power shifted. Instead of one big bank saying yes or no, you could now present your idea to thousands, even millions of regular people all over the world. People just like you. This is the heart of digital capital raising. It's about using technology to connect those who need money directly with those who have money to give or invest. No middleman, no closed doors. This new landscape is all about democratization. That's a big word, but it has a simple meaning: giving power to the people. Think about it. A small business owner in a small town can now get funding from someone sitting in a big city apartment hundreds of miles away. These are tools that you can use, whether you are looking to grow your own money or trying to get the funds to start something amazing. The digital age has opened the door to financial opportunity for everyone. You just have to be smart, strong, and secure enough to walk through it. And I'm here to show you how. Let's start with a concept called crowd investing. The name says it all. A crowd of people comes together to invest in a business. In the past, you needed millions to own a piece of a startup. Not anymore. With crowd investing platforms, startups offer small pieces of equity online. You might invest $100, someone else might invest $500, and another person $50. Together, all those small investments add up to the capital the company needs. In return, you become a part owner. If that company succeeds, the value of your small piece could grow substantially. Of course, you must know that this is an investment, and all investments come with risk. You must approve of the risk you are taking. Many startup companies fail, and if they do, you could lose your entire investment. That is the truth, and you cannot ignore it. But for a company, this is a game changer. Imagine a local brewery that wants to expand. Now let's talk about crowd lending. This is a little different. With crowd lending, you are not buying a piece of the company, you are acting like a bank. You are lending money to a business, and in return, the business agrees to pay you back with interest over a set period of time. Hundreds of people can each lend a small amount through an online platform, or even thousands. All those small loans are bundled together to give the business the total amount it needs. The business gets its loan often faster and with more flexible terms than a traditional bank. You, the lender, get to earn interest on your money, often higher than a savings account. But again, there is risk. If the business fails and cannot repay its loan, you could lose your money. You must never lend money you cannot afford to lose. Period. Now we get to the most well-known form of digital fundraising: crowdfunding. This is where things get really personal and beautiful. Crowdfunding is typically not about investing or lending for a financial return. It is about people coming together to support an idea, a project, a cause, a person they believe in. It is based on donations. You give a small amount of money, $5, $10, $25, not because you expect to get rich, but because you want to see something happen. It is the digital version of passing a hat around, but on a massive, global scale. People use it for funding an independent film, launching a new board game, helping a neighbor pay for unexpected medical bills. The process is simple and powerful. A creator or organizer sets up a page on a crowdfunding platform like Kickstarter, GoFundMe. They tell their story, explain what they want to do, and set a fundraising goal. Then they share it with the world. People who are moved by the story or excited about the project can donate directly on the page. Often, creators will offer small rewards to thank their backers. For example, a $10 donation might get you a digital download, while a $50 donation might get you a signed CD. Think about a young inventor who has designed an amazing new kind of backpack. She doesn't have the thousands of dollars needed for the first manufacturing run, so she creates a crowdfunding campaign. She makes a video showing off the backpack's features and shares her passion. People from all over the world see it and get excited. Thousands of people pre-order the backpack by donating to her campaign. This gives her the exact amount of money she needs to place the factory order. Without crowdfunding, that brilliant idea might have never left her sketchbook. Instead, a community of backers helped turn her dream into a real product. Finally, let's talk about how this digital revolution affects you directly when you need to borrow money. This is called marketplace lending, or sometimes peer-to-peer lending. For decades, if you needed a personal loan to consolidate credit card debt, pay for a wedding, fix your home, you had one choice: go to a bank or a credit union. They would check your credit score, look at your income, and decide whether to give you a loan and at what interest rate. It was an impersonal process, and if your credit wasn't perfect, you could face sky-high interest rates or an outright denial. Marketplace lending changes that dynamic completely by cutting out the bank. Here's how it works. You go to a marketplace lending website and fill out a loan application. The platform uses technology to assess your creditworthiness and assign you a risk grade, which determines your interest rate. But here is the key difference. The money for your loan doesn't come from the platform itself. It comes from individual investors who want to earn interest on their cash. Your loan request is listed on the marketplace, and investors can choose to fund a small portion of it. One person might contribute $50, another $100, until your entire loan is funded by a crowd of investors. For borrowers, this can be a fantastic alternative. These online platforms have lower overhead costs than big banks with branches, so they can often offer lower interest rates, especially for people with good credit. The application process is typically faster and entirely online, giving you a decision in minutes instead of days. For someone trying to get out from under high-interest credit card debt, refinancing with a lower-rate loan from a marketplace lender could save them thousands of dollars in interest and help them pay off their debt much faster. For the investors on the other side, it offers a new type of asset class. They can spread their money across hundreds of different loans, diversifying their risk. If one borrower defaults, it only affects a tiny portion of their overall portfolio. In essence, these platforms have created a world where regular people can act as lenders to other regular people, all facilitated by technology. It is a powerful example of how digital finance is breaking down old walls, making borrowing more accessible and affordable, and creating new opportunities for everyone to participate in the financial system.